In this time of constant change, you've challenged most of the traditional models of organizations and of giving, the conventional paths to philanthropy. One of those things is impact investing. Describe how you approached this new model.
I think we recognized early that given the profound changes in the world and given the huge social problems that the world is confronting, and environmental problems, and just sort of general capacitating itself in this time of flux, that there were not enough philanthropic dollars, there were not enough development dollars from the World Bank or what individual governments were doing, and that unless we help to figure out a way to unleash the capital in the private sector, that we weren't going to be able to solve these problems. And because the private sector reflected so many individuals who really were thinking a lot about their own philanthropic impulses, the question was, could you develop the kinds of funds that really allowed people to seek a financial return, which is totally appropriate, but at the same time also seek a social return, rather than thinking, okay, my charitable impulses get fulfilled over here, my business impulses get fulfilled over here, and I don't think of a way creatively to integrate those two when it's appropriate.
When are financial impact and social impact at odds, in the sense that often social impact, or the ability to see some of the metrics of success, often are over a very long period of time? How have you looked at these different potential conflicts and bridged opportunities to create a common language between these interests?
Right. Not every investor is going to be right for this asset class. And it is now an asset class. There could be equity, social impact investing, there could be debt structures, layered and mezzanine funding. And that itself is interesting because investors have looked at the financial only and looked in each of those categories. So there are in the social categories. But there is absolutely no doubt that it is still relatively patient capital. It is not for the investor who is looking for a 30% return next year. We're intermediators here. But generally, it is in the 7 to 15%, 8 to 20% kind of range in terms of rate of return. And there needs to be enough of a social rate of return, and people really need to hold themselves accountable to measures on the social side in the same way that the financial side has them, in order to feel good and comfortable about it. So not for every investor, not for every type of investment, but there is a much broader category than people might imagine.
Do you think that this type of approach will continue to scale? And how do you think it will impact organizations that have received, as you said, some of the charitable dollars versus the integrated investment from people before?
I think this field is accelerating, so it has gained a great deal of momentum. The investors right now are often family wealth funds, private bank investors, not so much yet pension funds, although what we're seeing and what will surely accelerate it are those large pools of capital sitting in pension funds. What they are waiting for and what they are starting to get is an evidence base from the earlier investments and what are the payouts, because they have ERISA requirements and things. So they need to know that. As the data are becoming clearer, and again, there's been a terrific report that JP Morgan and the Global Impact Investors Network did, showing already really compelling results, the pension funds are getting more and more interested. So there's no question this is a momentum wave that we have helped accelerate because we took the role of intermediary. We helped build the Global Impact Investors Network. We funded grantees who would define how to do social due diligence and what social impact ratings look like. So we've worked to really promote that field. I don't think it will keep people from giving to charity. I think it adds to their opportunities, but I would be amazed, and we haven't seen any evidence of that it detracts from charitable giving.